Welcome, everyone, to another episode of the AI Cash Grain Podcast. Today is Sunday, March 24th. I am your host and the Director of Data-Driven Strategies at Quantum Hedging, Satish Nandapurkar.
I'm Cy Monley, Head of Trading.
And I'm Kevin McNew. I handle our models.
This week, corn and soybeans diverged a bit again. December corn was up 5 cents to 4.75, while November beans were down 4 cents to 11.87. Clearly, the market is waiting for the plantings report on Thursday. Corn is up 27 cents over the last 30 days. We've had a decent reversal, while beans are up 69 cents, a nice reversal there too. As for our positioning, we're still 10% sold in corn at an average price of $471.62. We're likewise still 10% sold in beans at an average price of $1166.50. In both cases, we are in line with our benchmark, the traditional producer cash sale index. Again, for more information on our benchmark index, please see our website. As for our models, the forecasts have changed for the positive, much more so for corn than for beans. For corn, our model is now showing approximately a 2/3 chance of being higher by the end of June and also by the end of October. With beans, our model still shows a 65% chance of being lower by June and October, but that probability is not as bad as it was last week. However, our models are suggesting that the report on Thursday will be bearish for beans, and thus no beans will meaningfully trade lower after the report. Therefore, with the change in the models, while we're not recommending any sale today in corn ahead of that report, we are recommending everyone to sell 5% of their bean crop when the market opens after the weekend or on Monday. So we're actually going to jump the gun and recommend that you sell 5% of your bean crop before the report. Any sale Monday where the no futures price is above $11.75 is recommended, again, on just 5% of your expected soybean production. On Thursday, after the big plantings report, we will, of course, be running our models with updated data and provide further guidance afterwards for the end of the month, depending on how the data runs through our models and our simulations. I'll ask Kevin more about the models and how and why they've changed like they have and what they picked up on. But first, let's go to Cy for the trader's view and first talk corn like we always do. Cy, what do you think of this market? What do you think about this report? And, from a traditional trader's point of view, what are you seeing and thinking?
So thanks, Satish. Yeah, starting with corn, it's gone sideways. We've had a little volatility in beans, but that's position squaring, right? We still have global wheat prices on the bottom, even though there's been some discussion and chatter about Gasky and some wheat demand coming in, which has helped corn prices stabilize here. But the big thing everyone's waiting for is the crop report on Thursday. So I don't think we're going to see much movement, highs or lows being taken out in the recent corn prices up until we get the Thursday prices. And I think the way the traders view the market is this, Satish. You got a big short. You're going to need more bear news in front of the growing season for corn prices to go lower. So the average trade guess is right around 92.5 million acres of corn planted. If you're lower than that, that's new bull news, and corn can have a spike and get some of the corn shorts out, waiting for weather to give us our next leg in corn. So right now, I think the next 4 days is a wait and see pattern going into the report for corn.
Okay, thanks, Cy. Let's go to Kevin because Kevin, the models change, especially for corn. Let's talk corn. We were bearish last week. We're now neutral to bullish this week, out to the mid, even through the report, out to June, out to October. What changed? What did the models pick up on? What changed that really has us changing our thinking about our selling pattern for corn.
Yeah, and it is a meaningful change. I mean, if I look back at our forecast a couple of weeks ago for corn, we were seeing model predictions that were in the lower part of the $4 range, 440 up to kind of the meat of summer, and now we're pretty much flat out until we get into the heart of the growing season, with actually our forecast looking to see a little bit of a chance of going to $5. So I don't want to get farmers all bulled up here, as we say, but I think this is a positive sign. What has changed is some of the factors that we have been pointing to, like oil prices, are now starting to work in our favor. Oil prices have been stronger. We've gone meaningfully this month from mid $70 crude to we touched off the $82, $83 crude, and backed off a little bit at the end of the week, but still above $80, and that's helping the forecast. And I would say while the plantings report will be a big deal, there's still some negative headwinds in the corn market that are counterbalancing a potential bullish reaction. One is, the El Nino index. We've talked about how El Nino this time of year is actually pretty bearish for prices. And so that is a headwind that will be hard for the corn market to get very bullish ahead, or get very bullish as a result of this report. So, I'm optimistic that, this forecast is improving, and I think it's, our simulation model is indicating that we don't need to take action ahead of this report. But it's a dynamic and fluid situation. So that new data point coming on Thursday with prospective plantings will be important and will drive our forecast going forward in a meaningful way.
Great, thanks. I mean, clearly with this change in the models, we're not recommending any sale as we've really turned a little bullish. We're certainly not recommending a change before the data comes out on Thursday. This big number comes out on Thursday. So we're just holding with no recommendation for this week. However, for soybeans are a different story. The models are still bearish. As I mentioned, Cy, what do you think the traders are thinking here? What's the chatter on the street? What are they looking at? Do you concur with the models that the number coming out on Thursday is more likely to be bearish than bullish? What say you?
Yep. So let's say traders are specifically for beans, 85.5 million acres is that middle point. Like what Kevin was saying, Satish, in our models, we're leaning towards a higher end. So if you're picking it over, maybe it's closer to 86.5, 87. You run that through your balance sheets and, oh boy, we got a lot of beans for next year. Coupled with the fact the traders are talking about there is a lot of South American farmers that did not price beans. They kept hearing all year how bad the Brazil crop was, and they held on to their beans. Same thing in Argentina with the inflation, Milei, all these political and market chatter made global South American farmers hold on to their soybeans. They got a lot of crop to sell, Satish. So coupled with the fact that our model is saying more acres for soybeans and the global farmer has more beans to sell, I just don't see, from a probabilistic standpoint, how beans get super bullish. So the question,
hey, Cy, aren't we also historically pretty high on the soy corn ratio right now?
We're very high.
At the higher end of the range, which would kind of imply more soy acres coming up.
Yeah, and Satish, that also goes back for months. So farmers have been looking at this high ratio for months. So yeah, at 2.55 to 1, the ratio is telling farmers to plant more soybeans. So all those things coupled are giving the signal for beans to go down relative to corn. So the question is, what happens on the report? Does corn rally just a little bit? Do beans break more and corn holds? That's what the report's going to tell us.
Yep. Thank you. It's going to be an interesting report. Kevin, soybeans did improve a little bit, but your models are expecting a fall after the report and then kind of staying down there. So that's where the improvement is, staying down a little bit lower. what are the models picking up on? How have they changed? What are they saying?
Yeah, I think the takeaway for our listeners is that there's just not a lot of hang your hat on with soybeans to get very bulled up right now, and so while they did improve a little bit and took a lot of the downside risk out of the equation, there's still sizable downside risk. Low $11 is definitely in the cards from our model standpoint. We think that's a decent probability of it happening. The soy corn ratio, just circling back to what Cy said, that is a big driver of what we think will happen as a result, and it can have a lingering effect. And so I do think this is kind of why we're suggesting taking this soy action. The other thing, we actually in some ways will predict some of these metrics that go into our model, and we were running some of that analysis this morning. Satish, you were running it, and you showed our models for the soy corn ratio actually show it going down as we get into April and May, and so that's indicative of that we expect soy prices to fall relative to corn, and just reaffirms our commitment to selling beans right now. So I know farmers want all of our markets to go up, but there's just not a lot in the bean complex that says we need to be going higher.
Yeah, thanks for that, Kevin. And when we run the forecast again, the forecast is probably more accurate on the soy corn ratio going down, but what's coming out is that corn is turned a little bit bullish, but soybeans is still bearish for after the report, and therefore, when we run that through the simulations are saying you're better off selling now as we've got these higher prices than waiting till after the report for the end of the month. So therefore, we're going to send out a trade alert. We're recommending it right now. Sell 5% of your bean production on Monday, as long as the price, and it looks like the price is going to be in the 1180s, as long as the price is above 1175, for that no future, we'd recommend getting 5% of your bean production off before the report. And then we'll take in the data. Kevin will run the models. We'll run the simulation. We'll analyze the results, and we'll give you our recommendation for the end of the month post-report. But that, of course, is going to be data-driven.
The other thing, Satish, I wanted to just point out to our listeners is, something that has changed, pretty dramatically in the last year or so is, and that's the domestic situation around biofuels in soy. And so there was such a premium in the last couple years, 3 years really, as the biodiesel movement just really caught a bid and got really aggressive in growth. And and so the bean complex, soy crushes were through the roof, bean oil was through the roof, and that bubble has somewhat popped. We see very little strength in RIN prices for biodiesel. And so that's really kind of, I think, taken some of the oomph out of the bean complex. So, Cy, you've been talking a lot about the South American complex, which that's just bearish as all get out. But at home, I think the bean oil, bubble being popped is another factor that leads us to think there's not much upside here.
Yeah, and I just want to tell our listeners, when Kevin talks about what we're seeing, he's actually seeing it in the data. So we're constantly running scatter plots against, data against price changes and correlations. And when we say we are data driven and he talks about what he's seeing it in the data and the historical relationships and things. So, very interesting what you can see when you start to look across 100+ data items and see what that does in totality to the numbers. Sometimes some are voting for up moves, some are voting for down moves, but when we aggregate it together through our, proprietary models and our simulations, these are the recommendations, the forecasts and recommendations that we have.
Yeah, and I just wanted to piggyback on that, Satish. And I need to catch myself on this. I can get really hyper focused on what we would call a feature, one factor, one data item that we think might influence corn prices, bean prices, but that's just one in a whole host of this ecosystem of markets that drive prices. And so that's why we run these models. That's why that we put all of these features into them, and we let the models decide what are best and what interactions to use. So, don't fall prey to the notion of just focus on one thing, and that one thing is going to determine the outcome.
Yeah, that's a great point, Kevin. And that's actually what I think makes our process so much better, because we're letting the data drive it and tell us what has been important, versus relying on sort of historical, human precedent in terms of, you got to think about this at this time of the year. The other thing we have to, catch ourselves on is I mentioned forecasts on here, but it's really a range. There's a forecast and a standard deviation. You see that in the newsletter that we're sending out, the write-up. Our listeners should really be thinking about the range, because we're not saying that for sure it's going to a particular level. We're just saying that that's the middle of a range, and we have a range that we believe we have more confidence in than the market's viewpoint. So there's absolutely still uncertainty in our forecast, but we take that into account when we do simulations and things like that to figure out, what we should be doing. Anything else, Cy, Kevin, before we sign off?
I'm going to add on top of that. So when you're looking at a range, okay, for farmers, remember we are taking into account, like you guys said, so many variables that farmers should be thinking about taking action, right? Like, don't get too bullish, don't get too bearish. We're trying to give you those action items as well, right? And so we're when we're saying we're selling 5%, why? Because we think we're at the higher end of a range, right? And so that's why we're adding an extra 5% even in front of the report. So follow our recommendations. We're thinking about those things. We're thinking about the middle. We're thinking about the ranges. We're thinking about all the data. That's why we're trying to give advice as well, right? Like, hey, we've taken everything you guys talked about. We've taken those into effect, and we want to take action.
And that's a great point as well. And so I'll finish with that and just sort of say, it's that range and the uncertainty that's still there. You might ask, well, if you think it's going down after the report, why not sell 10%, 15%, 20%? Because there's still a reasonable amount of uncertainty. There's a lot of volatility. If anyone tells you they know exactly where it goes, they're lying. We've seen it in the 100 different data items, how many things sort of contradict each other, and we have the models to aggregate it, but there's still a range. So we're careful. It's your grain. We're trying to get it priced and beat the index with a high probability. And so we're being very measured in our recommendations based on what the models tell us through the data. So perfect. I'll leave it at that. I'll sign off. Again, 5% of soybean production, sell it now. Corn, we're going to wait, and we're going to see how this report comes out on Thursday, run our models immediately, and we'll get right back to you with what those models say. So with that, I'm going to sign off. Thank you very much for listening, and we'll get another one next weekend to you after the report. Thank you.